This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
So you should have watched the recording and lecture for the initial capital gains tax chapter, because it gave us all the basics of how we work out the proceeds, we work out the cost, what the computation looks like, what rates you pay and how we pay at those rates, and also when the tax is due, all sorts of various different aspects. This chapter builds on that chapter and deals with one specific aspect of capital gains, which is shares. Now remember, we are looking for proceeds minus cost equals gain. And we have looked at shares very briefly right at the beginning of the previous chapter, where we looked for the mid price where the shares were quoted. We did that because we weren't sure how the prices fluctuated during the day and at what point did we therefore work out the price per share. So let's have a look at shares in more detail. Gilt-edged securities and qualifying corporate bonds, they are exempt. Now the full list of exemptions is in the previous chapter. And again, you should have watched that chapter before you came to this one. Now, with shares, we have a kind of issue with people tend to buy them in patches. So they'll buy 500 this month and 700 the month after, or 2,000 the year after that. And they're all the same shares, same company, same type of shares. So you can end up with a parcel of about 4,000 or 5,000 shares. I don't know, however many as an example. But they've been bought over several years in several portions and at several prices. So what is the cost that we need to attach to our computation for those shares? Now, in order to clarify this, the Revenue have introduced matching rules. Now, for individuals, the acquisition of shares is matched in the following order. It will all make sense when we get some numbers. Shares are bought on the same day. Within 30 days following the sale, those are called the bed and breakfast rules. And those that are in the share pool, which is a pool of shares altogether. Now, the rules are different, slightly different to companies, but when we do the corporation tax chapters, you will see the matching rules for companies there. Now, a share pool, the first two are quite easy to do. You either bought some on the same day or you didn't. You either bought some in the next 30 days or you didn't. But in the share pool, this is a record of all the other shares that weren't bought on the same day or the next 30 days that have been acquired in that same company. So it's the same company and the same shares. So it will have various columns. A column for the number of shares, how many we have, the cost of the shares. Now, that number will include bonus and rights issue shares, which we will have a look at in a moment. Now, bonus shares are the free ones, and the rights ones you paid for. As I say, we'll have a look at those in a minute. And then any disposals. So what you bought, what you've got, how much you paid for them, and what you sold them for. So we're going to have a look at an example number 1. So Jane owns some shares in ABC Limited. Now, she bought 1,500 shares in May 2017, which she paid £20,000 for. She bought some more in June 18, which she paid £10,000 for. And then in July 22, she bought a further 200 shares for £4,000. Now, she has sold 1,000 of the shares. Now, how many does she have? She has 1,500 shares, she has 500 shares, and she has 200 shares. That's how many shares she owns, and she sold 1,000 of them. And that's your proceeds. So we need to work out what is the cost. Okay, let's have a look at how we do that. So first thing we do is we match. Now this matching, okay, these are rules, and as with all of these things, if it's a rule and you're having to deal with it, will you please write it down? All right, so matching, were there any shares bought on the same day? If you read the question carefully, she sold them on, let me just check my question, 28th of June. Did she sell any on the, buy any on the 28th of June? No, she didn't. However, did she buy any in the next 30 days? You want to read your question? Yes, she did, didn't she? She bought some on the 7th of July. She bought 200 shares. So they need to be matched together. There is therefore the remainder number of shares, because altogether she sold 1,000, didn't she? So on the same day, none. 30 days, 200, which means in the pool there will be the 800 to make the total of 1,000. Okay, 200 there and 800 there. Now that tells me I don't have to do a computation for that because there's nothing there, but I am going to have to do two computations. So the first computation is the sale on the 7th of July. Now what we have to do therefore is to the proceeds that she received, which the question says were £25,000, that has to be split between the two computations using the share ownership as the figure to work it out. So 200 shares were bought out of the 1,000. So 200 out of the 1,000 of the proceeds goes into this computation. Okay, so it's done according to the number of shares that we're dealing with. Now the cost is what was in the question, that was in the question, which gives us a gain here of 1,000. Now we've got 800 shares that are in the pool. If you remember, I told you that the pool is the collection of all the other shares that were not either bought on the same day or we've dealt with the 30 days. And they're always put in the pool in the order in which they were bought. So this has been copied from the question. 31st of May, she bought 1,500 shares, which cost her £2,000. Copy from the question. 30th of June 2018, she bought 500 shares, which cost her £10,000. Subtotal. Because now we are going to remove 800 shares. Okay, we're going to remove 800 shares. Now there's several ways that you can do this. I do 800 out of the 2,000 times 30,000. That's my kind of way my brain works. 800 out of the 2,000 multiplied by that will give me that. That's the way my brain works. Okay, these are the balances carried forward. For future capital gains tax computations. So the proceeds are the 800 out of 1,000, the balance of the original proceeds. We've got 5,000 in the top there, and we're putting 20,000 in here. This figure is the disposal cost, the original cost, giving us a gain. If we add the two gains together, we get capital gains in total of 9,000. So those rules, go over them again. We always first match the rules, same day, next 30 days, everything else goes in a pool in the order in which you bought them. It has in the number of shares, how much we paid for them, and any disposals. And we have example 1 there that explains how that works. Now, mentioned earlier bonus issues. A bonus issue is a free issue of shares to existing shareholders in the proportion of their existing holding. So we have here an example of Graham, who had the following transactions in a company called Alderholt. In February 2018, he bought 7,000 shares. In June 18, he bought another 1,000 shares. Now, in July, there was a bonus issue of 1 for 5. And then in October 2022, he sold 5,000 of those shares. So we have got to work out the capital gain arising on the disposal of those shares in October 2022. Okay, first things we have to do, always, even if it's not applicable, do the matching. Same day, were there any shares bought in October 22? The answer is no. Were there any bought in the next 30 days? The answer is no. Therefore, all the shares will come out of the pool. And that's what we need to construct first. Okay, so let's have a look. And it's part of the workings, but it's very important. Now, if you wrote that down, you'd probably get value marks, merit marks, because you know that is the rule, and you've applied it to this question and worked out there's only one computation I've got to do. I'm going to construct a pool, and then I'm going to work out the chargeable gains as a result. There's your matching. All right. Now, the pool is all the shares that have been bought in the order in which they were bought. So they have been copied from the question. Headings, the number of shares. Perhaps you could put a heading there, date, and the cost. We've copied those from the question. We've then subtotaled it. So we have 8,000 shares, which cost us £19,000. The bonus issue in July 18 was 1 for 5. Therefore, they're going to get another 1,600 shares. There is no cost related to that. Subtotal it again. And then remove those 5,000 shares. So 5,000 divided by 96 multiplied by that will give you this 9896. That's the figure that goes into your computation. That's the subtotal. That's the balance on the share pool carried forward. The capital gain, therefore, is the proceeds which came from the question, the cost which came from your working, giving you a gain. Okay. So let's go back and have a look what the difference between a rights issue, a bonus issue, and a rights issue. Now, in a rights issue, the existing shareholders have the right to buy new shares in proportion to their existing shareholding at a price very much below market value. So the share pool will increase by the number of shares that they have, just like the bonus, but also the cost of those shares that they've paid for. So example number 3 here. Mark, an employee of Bromley, had the following transactions. So in February 18, he bought 6,000 shares of £1,500. In June 18, he bought 900 further shares. And then in July, he took up a rights issue, 1 for 3, and each share was £3 per share. and then he sold some shares. Exactly the same as we've done before. Match. Did he buy any on the same day? No, he didn't. Next, 30. No, he didn't. Therefore, all of my shares will come out of the pool, and I only need one computation. So let's check and see how that looks in the answer. And again, the pool is a collection of all the shares that have been bought in the order in which they were purchased. So these have been copied from the question. Rights issue. Date. Maybe put a heading there. A rights issue of 1 for 3, which means we're going to get 2,300 shares. They're valued at £3 each, which means we add in the cost in there of those 2,300 shares at £3 each. Then we deduct the number of shares. 6,000 shares have been sold out of the pool. To find out what the cost is, we do that calculation. That's our balance carried forward. Now, this is important. In a pressured situation like an exam, you see how I've double underlined that, finished it off and labelled it? What I don't want you to do is to write that figure in there, look up and see that one, 8,557. Because that's not the cost. That's the figure carried forward. Now it happens, it's happened to me, it'll happen to the best of us, okay? The cost is this figure. And that's what needs to go in there to work out the capital gain.